I am about to tell you about the biggest financial time bomb in the market right now. A bomb that almost nobody is talking about. A bomb that is bigger than the subprime mortgage crisis that I famously predicted in 2005 and 2006. A bomb that has been growing silently, hidden from public view, sheltered from regulators, and protected by some of the most powerful financial institutions in the world. And when this bomb explodes, and it will explode, the devastation will be unlike anything we have seen since 2008, maybe worse. I have spent the last 18 months studying this market obsessively. I have read hundreds of loan documents. I have analyzed the financial statements of companies that most people have never heard of. I have talked to industry insiders who are terrified but cannot speak publicly because their careers would be destroyed. And what I have found keeps me up at night, because this is not a theoretical risk. This is not some academic exercise about what might happen in some distant future scenario. This is happening right now. The fuse is already lit, and most investors, most retirees, most pension funds have no idea that they are sitting on top of a powder keg. The bomb I am talking about is private credit, and if you have not heard this term before, you need to pay attention, because your retirement savings, your pension, your financial future may depend on understanding what I am about to tell you. Let me start by explaining what private credit actually is, because the financial industry has done an excellent job of obscuring this market from public view. That obscurity is by design. It is how they get away with things that would never be tolerated in public markets. Private credit, also called direct lending or private debt, is when non-bank lenders, usually private equity firms and specialized credit funds, make loans directly to companies. These are not bonds that trade on public exchanges. These are not bank loans that are subject to banking regulations. These are private agreements between lenders and borrowers, with almost no transparency, almost no regulation, and almost no oversight. The private credit market barely existed 20 years ago. In 2005, when I was researching the subprime mortgage market and discovering the fraud and abuse that would eventually crash the global financial system, private credit was a tiny niche market. Maybe $100 billion total, a rounding error in the global financial system. Today, the private credit market is approximately $1.7 trillion. Let me say that again, $1.7 trillion, and it is growing at over 20% per year. Some estimates suggest it will reach $2.5 trillion by 2028. This explosive growth has happened almost entirely outside of public view. There are no tickers to watch. There are no quarterly earnings calls to analyze. There are no SEC filings to read. It is a shadow financial system operating parallel to the regulated banking system, and it has become enormous. Now, you might ask, why does this matter? Why should you care about loans between private equity firms and companies you have never heard of? Here is why. Because this money is not coming from wealthy individuals who can afford to lose it. This money is coming from your pension fund, your retirement account, your state employee pension, your teacher's pension, your firefighter's pension. Institutional investors, desperate for yield in a low interest rate world, have poured hundreds of billions of dollars into private credit funds. And they have been told it is safe. They have been told it is stable. They have been told it provides reliable income with low volatility. They have been lied to. Let me explain why this market is a disaster waiting to happen. And I want to be very specific, because vague warnings are useless. I want you to understand the exact mechanisms that will cause this crisis, just like I understood the exact mechanisms that would cause the subprime crisis before anyone else saw it coming. The first problem is the quality of the borrowers. Private credit exists because banks will not lend to these companies. Think about that for a moment. Banks, which have very low cost of capital and make money by lending, have looked at these companies and said, no, thank you, too risky. So these companies turn to private credit, which charges much higher interest rates, often 10 to 15%, sometimes higher. Who borrows at 15% interest rates? Companies that are desperate, companies with weak business models, companies with too much debt, companies that could not get financing anywhere else. These are not blue chip corporations. These are often struggling businesses that private equity firms have loaded up with debt through leveraged buyouts. The private equity firm buys a company, strips out costs, loads it with debt, extracts fees, and then hopes to flip it to someone else before the whole thing collapses. And the debt they load onto these companies? Much of it comes from private credit. I have looked at some of these loan documents. The financials are terrifying. Companies with debt to EBITDA ratios of 7, 8, 9 times. For those who do not know what that means, EBITDA is a measure of operating earnings. A debt to EBITDA ratio of 9 means the company has 9 years' worth of operating earnings in debt. That is an insane amount of leverage. If anything goes wrong, if revenues decline even modestly, if interest rates rise, if the economy slows, these companies cannot service their debt. They default. In the public markets, if a company had these kinds of leverage ratios, it would be rated CCC or lower, deep junk territory. The kind of debt that sophisticated investors treat as highly speculative, almost equity-like risk. But in private credit, these loans are being sold to pension funds as safe, stable investments. The marketing materials show smooth returns with low volatility. What they do not show is that those smooth returns are based on made-up valuations that will collapse when reality catches up. The second problem is the valuation fraud. And I use the word fraud deliberately because what is happening in private credit valuation is, in my opinion, fraudulent. In public markets, securities are marked to market every day. If a bond declines in value, you know immediately. The price adjusts. Your account statement reflects the loss. This is painful, but it is honest. It forces investors to confront reality. In private credit, there is no market. These loans do not trade on exchanges. There is no daily price quote. So how do they determine the value of these loans? The fund managers make it up. I am not exaggerating. They hire friendly valuation firms who use models that the fund managers provide with assumptions that the fund managers determine to produce valuations that the fund managers want. The result is that private credit portfolios show remarkably stable values even when the underlying borrowers are deteriorating. Even when comparable public debt is trading at 60 or 70 cents on the dollar, the private credit version of the same loan might be marked at 95 cents. Why? Because no one is forcing them to market lower. Because lower marks would reduce their performance fees. Because lower marks would trigger investor redemptions. Because lower marks would reveal that the emperor has no clothes. This is exactly what happened with subprime mortgage securities before 2008. The models said they were safe. The rating agencies stamped them AAA. The marks stayed high even as the underlying mortgages were defaulting. And then suddenly, catastrophically, reality caught up. The marks collapsed. The securities turned out to be worth a fraction of their stated value. And the entire financial system nearly imploded. I see the same dynamic playing out right now in private credit. The marks are fake, the values are inflated, and when reality catches up, the losses will be catastrophic. The third problem is the liquidity mismatch. Private credit funds have raised money from investors with various redemption terms. Some funds are locked up for 7 or 10 years. But many funds, especially those marketed to retail investors and smaller institutions, promise quarterly or even monthly redemptions. The marketing says you can get your money back whenever you want. But the underlying loans are illiquid. There is no market for them. If investors start redeeming, if they want their money back, the fund has to sell loans. But there are no buyers. Or the only buyers are vulture funds who will pay 30 cents on the dollar. The fund faces a choice. Sell at fire sale prices and crystallize massive losses, or suspend redemptions and trap investors in a black hole. We saw this exact dynamic in 2008 with auction rate securities and money market funds. Products that were marketed as safe and liquid turned out to be neither. Investors who thought they could access their money discovered they were trapped. And that dynamic, that sudden realization that you cannot get your money back, that creates panic. That accelerates the crisis. That turns a problem into a catastrophe. The private credit industry is setting up for exactly this scenario. They have told investors they can redeem, the investors believe it, but when the time comes, when enough investors try to get out, they will discover the liquidity does not exist, and the panic will feed on itself. The fourth problem is the interest rate exposure. Most private credit loans are floating rate. This means the interest rate the borrower pays adjusts with market rates. When the Federal Reserve raised rates from near zero to over 5% in 2022 and 2023, the interest expense on these loans nearly doubled or tripled. At first, the private credit industry celebrated. Higher rates mean higher income for lenders, right? The funds reported stellar returns. The marketing materials touted the benefits of floating rate exposure in a rising rate environment. But here is what they did not tell you. Higher interest rates are crushing the borrowers. Companies that were barely able to service their debt when rates were at 3% are now paying 6 or 7 or 8%. Their interest expense has doubled. Their cash flow is being consumed by debt service. They have nothing left for capital expenditure, for investment, for growth. They are slowly being strangled. And many of these borrowers have been surviving by not actually paying their interest in cash. Instead, they are using a structure called PIK, payment in kind. Instead of paying interest with money, they just add it to the loan balance. The loan gets bigger every quarter. The borrower kicks the can down the road. And the lender reports income even though no cash actually changed hands. This is financial engineering that masks deterioration. The borrower looks current because they have not missed a payment. The lender reports strong returns because the stated interest rate is high. But no real money is flowing. The debt is just growing. And eventually, inevitably, the house of cards collapses. The fifth problem is the fee extraction. Private credit funds charge enormous fees, not just management fees, although those are typically 1.5% to 2% per year. They charge performance fees, typically 20% of profits above a hurdle rate. They charge origination fees when they make loans. They charge amendment fees when loans are modified. They charge exit fees when loans are repaid. They charge everything they can think of to extract money from investors. And here is the insidious part. Many of these fees are charged based on the fake valuations I mentioned earlier. If the fund marks a loan at par when it is really worth 70 cents, they collect management fees on the full value. They might even collect performance fees based on the fictional appreciation. The incentives are completely corrupted. Fund managers have every reason to inflate values because their compensation depends on it. They have every reason to hide problems because disclosure would reduce their fees. They have every reason to extend and pretend to modify troubled loans rather than recognize losses because recognition would hurt their performance and their bonuses. I saw this same incentive corruption in the mortgage market before 2008. The originators got paid for volume, not quality. The rating agencies got paid by the issuers they were supposed to rate. The servicers got paid fees regardless of whether borrowers defaulted. Every participant in the system had incentives to ignore problems and keep the machine running. Until it could not run anymore. Private credit has the same corrupted incentive structure. And it will produce the same result. Now, let me tell you about some specific things I have found that should terrify anyone with money in this market. I have seen loans to companies that have missed their original projections by 50 or 60%. Revenue is half of what was forecast when the loan was made. Profits are non-existent. And yet the loan is still marked at par, still carried as if nothing is wrong, still included in the fund at full value. I have seen loans that have been amended 5 or 6 times. Each amendment loosens the covenants, gives the borrower more time, adds fees to the balance. Each amendment is a tacit admission that the borrower is failing. And yet, the loan stays marked at par. I have seen loans where the interest reserve, money set aside at closing to pay interest for the first year or two, has been entirely consumed. The borrower has no ability to pay interest from operations. They are running on fumes. And yet the loan stays marked at par. I have seen entire portfolios where more than half the loans are on watch lists, internally flagged as potential problems. But externally, in the marketing materials, in the investor reports, everything looks fine. Returns are stable, defaults are minimal, nothing to see here. This is fraud. There is no other word for it. Investors are being told their money is safe when it is not. They are being shown returns that are fiction. They are being led to believe they own performing loans when they own disasters waiting to happen. And who are the victims? Not sophisticated hedge funds who can afford to lose. Not wealthy individuals who have diversified portfolios. The victims are teachers and firefighters and state employees whose pensions have been stuffed with this garbage. The victims are retirees who were told private credit was a safe alternative to bonds. The victims are regular people who trusted the financial system and are going to get crushed. Let me tell you about the catalyst that I think will trigger this crisis. Because every bomb needs a spark. The spark will be a major default or bankruptcy that cannot be hidden or explained away. Some large, well-known private equity-owned company will fail. The debt will be written down to 20 or 30 cents on the dollar, and investors will suddenly realize that if that loan was worth 20 cents, what about all the others? What about all the loans that look similar? What about the entire portfolio? That realization will trigger redemption requests. Investors will want out. They will call their private credit funds and ask for their money back. And the funds will face that impossible choice I described earlier: sell at fire sale prices or suspend redemptions. Some funds will try to sell. They will dump loans into a market that has no buyers. Prices will collapse. Other funds will see their competitors selling at 50 cents and realize their marks at 95 cents are fiction. They will have to write down too. The contagion will spread. Other funds will suspend redemptions. They will gate their investors, trap them in the fund, refuse to return their capital. This will cause panic. Other investors will rush to redeem before they get trapped too. The redemption pressure will intensify. Banks that have lent to these private credit funds, and many have, using the loan portfolios as collateral, will demand repayment or additional collateral. The funds will not have it. More forced selling, more price discovery, more revelations of fraud. The losses will cascade through the financial system. Pension funds will have to recognize billions in write-downs. Insurance companies will see their capital impaired. Banks will face losses on their loans to the credit funds. The companies that borrowed from these funds will fail when their credit lines are pulled and their loans are called. This is not speculation. This is the inevitable consequence of the current structure. Too much debt, too much hidden risk, too many fake valuations, too much leverage. The only question is when, not if. And I will tell you something else. The regulators know this is coming. The Federal Reserve has mentioned private credit as a potential stability concern. The SEC has started asking questions. But no one wants to pull the plug. No one wants to be the one who triggers the crisis. So they let it build. They let the bomb get bigger. And when it finally explodes, they will claim they could not have seen it coming. I have seen this movie before. I lived it in 2007 and 2008. The warning signs were there for anyone who looked. The data was available. The analysis was straightforward. But the industry did not want to see it. The regulators did not want to see it. The investors did not want to see it. Everyone was making too much money. And then it all collapsed. And everyone claimed to be surprised. I am not going to be surprised this time either. And if you are listening to me, you do not have to be surprised either. Now, let me tell you what you should do about this. Because understanding a problem is useless if you do not act on it. First, find out if you have exposure to private credit. If you have a pension, ask your plan administrator what percentage is allocated to private credit, direct lending, or alternative credit. If you have an IRA or 401k, check if any of your funds have private credit exposure. Some target date funds and balanced funds have started adding private credit. Some insurance company products have private credit behind them. Do not assume you are not exposed. Verify. If you find you have exposure, consider reducing it if you can. I know that is not always possible with pensions. You cannot simply withdraw your pension balance. But if you have choices, if you can move money between options, consider moving away from anything with private credit exposure. This is not a situation where you want to wait and see. The losses, when they come, will be sudden and severe. Second, be very skeptical of any investment promising high yields with low volatility. This is the marketing pitch for private credit. 8% yields with bond-like stability. It sounds too good to be true because it is too good to be true. The yields are real, for now. The stability is fake. It is manufactured through fraudulent valuations. When the marks are adjusted to reality, the stability will disappear and the losses will be shocking. If something promises equity, like returns with bond-like risk, you should assume they are lying to you. Finance does not work that way. There is no free lunch. If you are getting paid high yields, you are taking high risk. The only question is whether the risk is visible or hidden. In private credit, the risk is deliberately hidden, but it is there, and it will manifest. Third, understand that this crisis will have broad effects beyond just private credit. When private credit collapses, it will take down companies that rely on this financing. There will be a wave of bankruptcies among private equity-owned companies. This will affect employment, suppliers, communities. It will tighten credit conditions across the economy. Banks will become more conservative. Other lenders will pull back. Companies that had nothing to do with private credit will find it harder to borrow. The second-order effects could trigger a recession. Less lending means less investment, less hiring, less economic activity. This could be the catalyst for a broader economic downturn. So even if you have no direct exposure to private credit, you should be prepared for difficult economic conditions. Fourth, consider how this affects your overall asset allocation. If we are heading into a period of credit stress and potential recession, you might want to be more conservative in your investments. Hold more cash. Own high-quality bonds if you own bonds at all. Be cautious about highly leveraged companies or sectors dependent on cheap credit. Favor companies with strong balance sheets, real profits, and the ability to survive a downturn. I am not telling you to panic. I am not telling you to sell everything and hide in a bunker. I am telling you to be aware, to be prepared, to position yourself for a difficult environment. The people who got destroyed in 2008 were the ones who did not see it coming, who were fully invested in the wrong things, who could not adapt when conditions changed. You do not have to be one of them. Now, let me address something that you might be thinking. Michael, you have been bearish before, and sometimes you have been early, sometimes really early. How do I know this is different? How do I know the timing is right? You are right to be skeptical. I have been early on calls before. I was early on the housing crisis by about 2 years. I took enormous pain, lost capital, faced investor redemptions, questioned my own sanity. Being early is indistinguishable from being wrong until suddenly it is not. But here is what I will tell you about private credit. The deterioration is already happening. This is not about predicting some future event. The defaults are already ticking up. The amendments are already multiplying. The companies are already struggling to pay their interest. The only thing preventing the crisis from being visible is the fake valuations. And fake valuations can only hold for so long. In 2005, when I was betting against subprime, the mortgages had not defaulted yet. I was predicting that they would, based on the loan structures and the borrower profiles. I had to wait for the resets, for the teaser rates to expire, for the defaults to actually happen. With private credit, we are past that stage. The loans are already distressed. The borrowers are already failing. The only thing keeping the system together is the lie that everything is fine. And lies have a way of catching up with you. I do not know exactly when the crisis will become visible. It could be 6 months. It could be 18 months. But I do not think it is 5 years. The stress is too acute. The pressure is too great. Something will break, and when it does, the unraveling will be fast. Let me tell you something else about timing. The crisis in private credit will likely coincide with other stresses in the financial system. Commercial real estate is in trouble. Office buildings are seeing defaults and distress. Many of those loans were also made by non-bank lenders with similar dynamics to private credit. Bank balance sheets are under pressure from unrealized losses on their bond portfolios. We saw 3 large bank failures in 2023. There will likely be more. When multiple parts of the financial system are stressed simultaneously, the problems compound. A crisis in private credit could trigger a crisis in commercial real estate lending, could trigger bank failures, could trigger a broader credit contraction. These things do not happen in isolation. They feed on each other. This is why I am so concerned about the timing. We are not dealing with one isolated problem. We are dealing with a financial system that is stressed across multiple dimensions. Private credit is the biggest hidden risk, but it is not the only risk. And when things start to go wrong, they tend to go wrong everywhere at once. I want to close by talking about why this matters beyond just money. Because this is not just about investment returns. This is about trust in the financial system. This is about whether regular people can rely on institutions to tell them the truth. The private credit industry has systematically deceived investors. They have marketed risky loans as safe investments. They have used fraudulent valuations to hide losses. They have charged enormous fees while exposing people to enormous risks. They have taken advantage of pension funds and retirees who trusted them. When this blows up, it will further erode trust in the financial system. People will learn, again, that they were lied to, that the regulators failed to protect them, that the sophisticated financial institutions prioritized their own profits over their clients' well-being. This will make people even more cynical, even more distrustful, even more likely to believe that the system is rigged against them. And you know what? They will be right. The system is rigged. It is rigged to benefit the fee extractors, the insiders, the people who control the money flows. It is rigged against regular people who just want to save for retirement and not get cheated. I find this infuriating. I have spent my career trying to find the truth in financial markets, trying to see through the lies and deceptions, trying to profit by betting against fraud. But the fraud keeps happening. The lies keep getting told. The regular people keep getting hurt. When I bet against subprime in 2005 and 2006 and 2007, I was not cheering for the financial system to collapse. I was not hoping for people to lose their homes. I was betting on truth, betting that reality would eventually overcome the lies. And when I was proven right, when the crisis happened, I did not feel triumphant. I felt sick, because I saw the devastation. I saw the families losing their homes. I saw the workers losing their jobs. I saw the retirees losing their savings. I feel the same way now about private credit. I do not want this crisis to happen. I do not want pension funds to lose billions. I do not want retirees to see their savings evaporate. But it is going to happen. The math is the math. The lies can only hold for so long. And when it happens, I want you to understand why. I want you to be prepared. I want you to protect yourself as much as you can. Because no one else is going to protect you. The regulators will not. The industry will not. The politicians will not. They will all claim to be surprised. They will all say nobody could have seen it coming. They will all blame each other while regular people suffer the consequences. So, protect yourself. Understand the risks. Make informed decisions. Do not trust the marketing materials. Do not believe the smooth returns. Do not assume that just because something is sold by a reputable institution, it must be safe. The most reputable institutions in the world sold subprime garbage to their clients in 2006 and 2007. They will sell private credit garbage to their clients today. This is the warning. Private credit is a bomb. The fuse is lit. The explosion is coming. I do not know exactly when, but I know it is coming. And when it does, I want you to be as far away from the blast radius as possible. The $1.7 trillion private credit market is the biggest hidden risk in the financial system. It is bigger than subprime was. It is more opaque than subprime was. It is more concentrated in institutional hands than subprime was. And when it blows up, the devastation will be immense. You have been warned. What you do with this warning is up to you, but do not say nobody told you. Do not say you could not have seen it coming. I am telling you right now. I am telling you exactly what is happening, exactly why it is a problem, and exactly what you should do about it. The private credit bomb is about to explode. Get out of the way while you still can. But I am not done yet. Let me go deeper into the mechanics of how this market actually works, because I want you to truly understand what is happening. The more you understand, the better you can protect yourself. Let me explain the structure of a typical private credit deal. Because the devil is in the details. A private equity firm decides to buy a company. Let us say it is a manufacturing company with steady cash flows. The private equity firm does not use its own money for the purchase. Instead, they use a small amount of their own capital, maybe 20 or 30%, and they borrow the rest. Where does the borrowed money come from? Increasingly, it comes from private credit funds. The private credit fund makes a loan to the acquisition vehicle, secured by the assets of the target company. The interest rate is high, maybe 12 or 13%, because this is risky lending. The loan has covenants, restrictions on what the company can do, designed to protect the lender. So far, this sounds reasonable. But here's where things get dangerous. The private equity firm paid a high price for the company, a price that only made sense if the company could be improved dramatically. They need to cut costs, increase revenues, expand margins. They need the company to perform at a level it has never achieved before. If it performs at that level, the math works. The debt can be serviced, the equity holders make money, everyone is happy. But what if the company does not hit those aggressive targets? What if revenues are flat instead of growing? What if margins compress instead of expanding? What if the economy slows down? Suddenly, the math does not work. The company cannot generate enough cash to pay the interest on the debt. Something has to give. In a rational world, this would trigger a default. The lender would take control. The company would be restructured. The private equity firm would lose their investment. Losses would be recognized. The system would clear. But that is not what happens in private credit. Instead, there is a dance called extend and pretend. The lender does not want to recognize a default because that would mean marking down the loan and reporting losses. The private equity firm does not want a default because that would wipe out their equity, so they negotiate. The covenants get loosened. The company was supposed to maintain a certain ratio of debt to earnings, but they missed it. No problem. We will amend the covenant. We will give you more room. The loan stays performing. No default to report. The interest rate gets modified. The company cannot pay the full interest in cash. No problem. We will let you pay part of it in kind. Just add it to the loan balance. You do not have to come up with the cash. The loan stays current. No missed payment to report. Additional money gets advanced. The company needs cash to operate. The original loan is not enough. No problem. We will make an additional loan. We will call it a revolving credit facility. We will charge fees for the privilege. The company stays alive. The original loan stays performing. Each of these modifications is disclosed somewhere, buried in footnotes, hidden in quarterly reports. But the headline numbers stay clean. The loan is performing. The valuation is stable. The returns are smooth. Nothing to see here. Meanwhile, the actual situation is deteriorating. The company is weaker than when the loan was made. It has more debt, not less. Its operations are struggling. Its market position is eroding. But you would never know it from looking at the fund's returns. I have seen loans that have been amended 7 or 8 times. Each amendment is a mini restructuring, a tacit admission that the original deal did not work. But each amendment also resets the clock. As long as the borrower complies with the amended terms, the loan is considered current. The charade continues. This is not investing. This is a game of musical chairs. Everyone knows the music will stop eventually. Everyone knows there are not enough chairs. But as long as the music keeps playing, as long as the fees keep flowing, as long as the marks stay inflated, no one wants to be the one to call it out. Let me tell you about another structural feature of private credit that creates enormous risk. It is called covenant-light lending, and it is even worse than the extend and pretend game I just described. Traditional loans have maintenance covenants. These are financial tests that the borrower must pass every quarter. If they fail, they are in default, and the lender can take action. These covenants act as an early warning system. They catch problems before they become catastrophic. But over the past decade, as competition among lenders intensified, as private credit funds fought for market share, covenants have been weakened or eliminated entirely. Many loans today are covenant light. They have incurrence covenants instead of maintenance covenants. An incurrence covenant only gets tested if the borrower tries to do something specific, like take on more debt or make an acquisition. If the borrower just sits there, slowly deteriorating, the covenant never gets tested. There is no tripwire. There is no early warning. This means a company can be in deep trouble, losing money, burning cash, approaching insolvency, and technically not be in default on its private credit loan. The loan is covenant light. There is nothing to breach. The lender has no ability to intervene until things are so bad that the company literally cannot pay or goes bankrupt. By that point, the loss is enormous. The lender recovers 20 or 30 cents on the dollar instead of the 60 or 70 cents they might have recovered if they had caught the problem early. The covenant light structure that was supposed to be borrower friendly turns out to be a disaster for everyone. Why would lenders agree to covenant-light structures? Competition. There is too much money chasing too few deals. Private credit funds have raised vast sums and they need to deploy it. If one fund insists on strong covenants, the borrower will go to another fund that does not. The pressure to put money to work overwhelms the discipline to protect it. I have seen this before. In the mid-2000s, underwriting standards in the mortgage market collapsed for the same reason. Too much money chasing too few borrowers. Lenders competing by weakening standards. The originate-to-distribute model that separated the lender from the ultimate holder of the risk. The result was millions of loans that should never have been made to borrowers who could never repay. And we all know how that ended. Private credit is following the same path. Underwriting standards have collapsed. Covenants have been weakened or eliminated. Leverage has increased. And the people making these loans will not be the ones holding them when they default. They will have collected their fees and moved on. The losses will fall on the pension funds and insurance companies and retirees who trusted the system. Let me talk about another aspect of this market that keeps me up at night. It is the interconnectedness of private credit with the broader financial system. Private credit funds do not just use investor capital. Many of them also borrow from banks. This is called subscription line financing, or NAV financing. The fund borrows money from a bank, using either investor commitments or the loan portfolio itself as collateral. This allows the fund to juice returns. Instead of earning 12% on investor capital, they borrow at 6% and earn 12%, pocketing the spread. Returns look better. Performance fees are higher. But this leverage creates systemic risk. If the underlying loans start to default, if the valuations have to come down, the bank that provided the financing will demand repayment or additional collateral. The fund may not have it. The fund is forced to sell assets, any assets, to meet the margin call. This creates forced selling, which drives down prices, which creates more margin calls, which creates more forced selling. A doom loop. We saw exactly this dynamic with hedge funds during the 2008 crisis. Funds that had borrowed against their portfolios faced margin calls. They had to sell into a falling market. Their selling drove prices down further. Other funds faced margin calls. More selling. Prices collapsed. The same thing will happen with private credit, but potentially worse because the underlying assets are illiquid. When a hedge fund has to sell stocks or public bonds, there is a market. The price might be bad, but they can sell. When a private credit fund has to sell a privately held loan, there may be no buyer at any price. The market does not exist. The fund is trapped. Banks have also been extending credit to the companies that borrowed from private credit funds. So the same company might have a loan from a private credit fund and a revolving credit facility from a bank. When the company fails, both the private credit fund and the bank take losses. The bank's losses affect its capital. If the losses are large enough, the bank's stability is threatened. And bank instability affects everyone. This is what I mean when I say private credit is a systemic risk. It is not just about the funds themselves. It is about the connections to banks, to other lenders, to the real economy. When the private credit bomb explodes, the shrapnel will fly in all directions. Let me also address the role of the rating agencies in all of this, because their failure is contributing to the problem just like it did with subprime mortgages. Some private credit funds and related instruments do get rated by the major rating agencies, and the ratings are absurdly high given the actual risks. I have seen private credit vehicles rated investment grade that hold portfolios of deeply distressed loans. The rating methodology does not capture the true risks. It relies on historical data that does not reflect current conditions. It uses models that do not account for the correlation of defaults in a downturn. It gives credit for diversification that will not exist when the crisis hits. This is exactly what happened with mortgage-backed securities. The rating agencies stamped AAA on securities that turned out to be worthless. They used models that assumed housing prices would not decline nationwide. They gave credit for diversification that evaporated when all borrowers defaulted at once. They were wrong, spectacularly wrong, and their errors contributed to the severity of the crisis. The rating agencies have learned nothing. They are making the same mistakes with private credit that they made with mortgages. And when the crisis comes, they will issue the same excuses. Our models did not predict this. Nobody could have foreseen these conditions. We relied on information provided by issuers. Blame everyone but themselves. Let me also talk about the executives and managers who are running these private credit funds, because their incentives are completely corrupted. The typical private credit fund manager gets paid a management fee of 1.5% to 2% per year on assets under management, plus a performance fee of 20% of profits above a hurdle rate. These fees are enormous. A $10 billion fund generates $150 to $200 million per year in management fees alone, before any performance fees. What are the incentives created by this fee structure? First, get as much money under management as possible. More money means more fees. This creates pressure to raise capital even when there are not good opportunities to deploy it. It creates pressure to market aggressively, to tell a compelling story, to minimize the risks and emphasize the returns. Second, put the money to work quickly. Sitting on cash does not generate performance fees. Making loans does. This creates pressure to deploy capital even when deals are not attractive. It creates pressure to accept weaker terms, weaker covenants, higher leverage, just to get the money invested. Third, keep the marks high. Performance fees are calculated based on valuations. Higher valuations mean higher fees. This creates pressure to mark loans generously, to not recognize deterioration, to extend and pretend rather than admit problems. Fourth, avoid crystallizing losses. A realized loss is undeniable. An unrealized loss can be hidden with friendly valuations and optimistic assumptions. This creates pressure to never sell a troubled loan, to never force a confrontation, to keep zombie positions on the books indefinitely. These incentives are toxic. They reward exactly the behaviors that create and hide risk. They punish prudence and transparency. They create a system where the managers get rich while the investors bear all the downside. And who are the managers? They are smart, well-educated, well-connected people who understand exactly what they are doing. They know the marks are inflated. They know the loans are riskier than disclosed. They know the whole thing is a house of cards. But they are getting paid tens or hundreds of millions of dollars to keep the game going. They are not going to blow the whistle. They are not going to sound the alarm. They are going to collect their fees and hope they are retired on a beach somewhere before it all collapses. I do not say this to demonize all private credit managers. Some are trying to do the right thing. Some are running conservative funds with honest marks and careful underwriting. But they are competing against managers who are not doing the right thing, who are promising higher returns through higher risk and hidden leverage. And in the short term, the honest managers look like they are underperforming. The dishonest managers attract more capital. This is Gresham's law applied to asset management. Bad managers drive out good managers. The most aggressive, the least scrupulous, the most willing to take hidden risks, they win the competition for capital. Until suddenly they do not. Until reality catches up. Until the bomb explodes. Let me tell you about one more aspect of private credit that is particularly insidious. It is the way these funds are marketed to retail investors. For most of its history, private credit was limited to large institutions. Pension funds, endowments, sovereign wealth funds. These are sophisticated investors with resources to do due diligence, with scale to negotiate terms, with the ability to absorb losses. But in recent years, the industry has been pushing to access retail capital. They have created structures that allow individual investors to participate in private credit. Interval funds, business development companies, non-traded REITs that invest in credit. These vehicles are marketed to ordinary people as safe alternatives to bonds, stable sources of income, ways to earn higher yields without equity risk. The marketing is seductive. Look at these smooth returns. Look at this high yield. Look at how it is uncorrelated with the stock market. Your financial advisor gets a commission for selling it to you. The fund company makes fees. Everyone is happy, except you, the investor, who is taking risks you do not understand in exchange for fees you probably do not realize you are paying. These retail vehicles often have the worst terms, the highest fees, the most conflicted structures, the most opaque disclosures. Professional investors can negotiate. Retail investors take what they are given, and what they are given is often garbage wrapped in pretty packaging. When the private credit crisis hits, these retail investors will be devastated. They were told it was safe. They trusted their advisors. They did not understand what they bought. And they will lose a substantial portion of their savings. This is predatory. There is no other word for it. The financial industry is knowingly selling risky, illiquid, opaquely valued products to people who cannot afford to lose the money and do not understand the risks. They are doing it because the fees are lucrative and the disclosure requirements are minimal. They will express shock and sympathy when it blows up. They will keep the fees they collected. I want to end with a historical perspective because understanding the past can help us prepare for the future. Financial crises follow patterns. They begin with an innovation that seems to offer something for nothing. Higher returns with lower risk, safety and yield, the impossible combination that everyone wants. With subprime mortgages, the innovation was securitization. Take risky loans, package them together, slice them into tranches, and somehow the senior tranches are safe. Alchemy, turning lead into gold. Except it was not real. The risk did not disappear. It was just hidden, redistributed, concentrated in places no one was watching. With private credit, the innovation is opacity. Take loans that would be rated junk if they were public, keep them private, value them with friendly models, report smooth returns. Alchemy again, making risky loans look safe through the magic of illiquidity and opacity. But the risk does not disappear. It is just hidden, and when it becomes visible, the losses will be devastating. Every crisis also has its enablers. With subprime, it was the rating agencies who stamped AAA on garbage, the regulators who failed to enforce standards, the banks that securitized and sold knowing the loans were bad, the borrowers who lied on their applications, the appraisers who inflated values. Everyone had dirty hands. With private credit, the enablers are just as culpable. The fund managers who inflate valuations, the auditors who sign off on them, the consultants who tell pension funds to allocate to the asset class, the placement agents who earn commissions, the regulators who look the other way, the media that repeats the marketing messages without skepticism. Everyone is playing their part in a tragedy that is entirely predictable. And every crisis has its victims. With subprime, the victims were homeowners who lost their houses, workers who lost their jobs, retirees who lost their savings, communities that were devastated. With private credit, the victims will be pension beneficiaries, insurance policyholders, individual investors who trusted the system, regular people who did nothing wrong except believe what they were told by people who should have known better. I identified the subprime crisis years before it happened. I was called crazy. I was called wrong. I was questioned and doubted and dismissed. And then I was proven right in the most catastrophic way possible. I did not enjoy being right. I wish I had been wrong. The human cost of that crisis was enormous. I am identifying the private credit crisis now, before it happens. I will probably be called crazy again. I will probably be questioned and doubted and dismissed again. The fund managers will say their portfolios are different. The regulators will say they are monitoring the situation. The consultants will say the asset class has matured. They said all of these things about subprime too. But the math is the math. The leverage is too high. The valuations are fake. The borrowers are struggling. The structure is fragile. Something is going to break. And when it does, I hope you will remember that someone tried to warn you. The private credit bomb is about to explode. This is not hyperbole. This is not fear-mongering. This is a careful analysis of the facts, the structures, the incentives, the math. Everything points to the same conclusion. This market is a disaster waiting to happen. Protect yourself. Get out of the way. Do not be a victim. The warning has been given. The rest is up to you. Let me leave you with some specific numbers that should haunt you. The private credit industry has approximately $1.7 trillion in assets. Of that, industry insiders estimate that somewhere between 15 and 25% of loans are currently distressed or at risk of distress. That is $250 billion to $400 billion of troubled debt, most of it still marked at or near par value. When the marks adjust to reality, when the losses are recognized, where does that money come from? It comes from the investors. It comes from pension funds that will have to tell their beneficiaries that the money is not there. It comes from insurance companies that will have to raise premiums or cut benefits. It comes from endowments that will have to reduce their grants. It comes from ordinary people who trusted the system. The scale of potential losses is staggering. If average recoveries on distressed private credit loans are 40 cents on the dollar, which is actually optimistic given the leverage levels, the total losses could exceed $200 billion. $200 billion. That is real money. That is retirement savings. That is pension benefits. That is financial security for millions of people. And remember, this is just the direct losses on the private credit portfolios themselves. It does not include the cascading effects, the bank losses from lending to private credit funds, the bankruptcies of companies that lose their private credit financing, the job losses, the economic contraction, the second and third order effects that always accompany financial crises. When I predicted the subprime crisis, the total losses eventually exceeded $400 billion on the mortgage securities alone. But the total economic damage, including lost jobs, lost homes, lost output, reduced wealth, was measured in trillions. The direct losses were just the beginning. Private credit could be the same. The direct losses could be $200 or $300 billion. The total economic damage could be measured in trillions. This is not a contained problem. This is a systemic risk that threatens the stability of the entire financial system. I have done my best to explain this clearly. I have laid out the facts, the structures, the incentives, the math. I have told you what I see and why I see it. I have warned you about what is coming and how to protect yourself. Whether you listen is your choice. Whether you act is your choice. I cannot make you do anything. I can only give you the information and hope that you use it wisely. The private credit bomb is ticking. The explosion is coming. When it happens, do not say nobody warned you. Because I am warning you right now, today, in the clearest terms I know how to use. Get out. Get safe. Protect what you have. The storm is coming, and those who are not prepared will be swept away. That is all I have to say. The warning has been delivered. What happens next is up to you.